Hi everybody, and welcome back to video number 3 in chapter 6. When we left off, we were looking at this quick check involving our old friend Coffee Clatch. And with the same numbers we've been using throughout this chapter 6 slides. And so now they want to know what the break-even sales in units would be. So you'll remember that formula is going to be the contribution margin per unit divided into the fixed costs. So the contribution margin per unit is going to be $1.49 minus 36 cents. And if we divide that into 1,300, we will get 1,050 cups. So here's exactly what they did. Break-even point, fixed cost divided by contribution margin per unit. Here's our fixed costs. Here's the contribution margin per unit, which is $1.13. We divide that into $1,300 fixed cost, and that gives us 1,150 cups. And you can see that each time we sell a cup of coffee, we make a contribution to that fixed cost of $1.13. Okay, important calculation. Now, let's look at computing the margin of safety and explain its significance. Here, a margin of safety is the excess of budgeted or actual sales dollars over the break-even volume of sales dollars. And then it is the amount by which sales can drop before we incur losses. So the higher the margin of safety, the more comfort we have, and the lower the risk of not breaking even and incurring a loss. So the formula for the margin of safety is our total sales minus our break-even sales. So let's look at RBC and determine the margin of safety. If we assume RBC has actual sales of 250,000, given that we've already determined the break-even sales to be 200,000, our margin of safety is going to be $50,000. As shown, the difference between 250,000 and 200,000. Okay, so the margin of safety can be expressed as 20% of sales. In this case, $50,000 divided by our actual sales of 250,000. And that comes out 20%. Okay, the margin of safety can be expressed in terms of the number of units sold. And if we did that, the margin of safety is $50,000. Each bike sells for $500, so its margin of safety is 100 bikes. And you can see that easily from these numbers here, the difference between 500 units and 400 units. Okay, now, here's same information on Coffee Clatch, and now they want you to calculate the margin of safety expressed in cups. Okay, so the margin of safety expressed in cups is going to be 950. And we get that by taking the total sales minus the break-even sales. In this case, we're going to have $2,100 is our average selling sales in units minus the 1,050 that we just calculated here. I think we need to go back a little more that we calculated here. Okay, our break-even point in cups. Okay, margin of safety, 950 cups. So for every cup that we sell over our break-even point of 1,050, we make 36 cents. I'm sorry, we make $1.13. Okay, now we're going to calculate the level of sales needed to achieve the desired target profit. This one's actually very easy. We're just going to add that target profit on top of our fixed costs and do the same formulas we did for calculating the break-even point in units and the break-even point in sales dollars. So here we estimate what sales volume is needed to hit a specific target profit. We can compute that number of compute the number of units that must be sold to attain that target profit by either using the equation method or the formula method. So here our goal is to solve for the unknown Q quantity, which represents the quantity of units that must be sold to attain the target profit. So if we work this all the way through the formulas here, you can see that essentially what we've done, the difference between the break-even point in units, which is fixed cost divided by the contribution margin per unit, we simply add the 80,000, I'm sorry, the 80,000 was the fixed cost, and we simply add the $100,000 of target profit on top of the $80,000 fixed cost and divide that through by the contribution margin per unit. And that says that we need to sell 900 units to make $100,000 in operating profit. Okay, so the unit sales to attain that target profit, then we're going to take the target profit plus the fixed cost divided by the contribution margin per unit. And that's the formula. Okay, everybody good with that? Now, we can also do then how much in sales we need to make to earn a profit of $100,000. So here, our unit sales is going to be 900 units. We did that previously. We took our target profit plus our fixed expenses divided by our contribution margin per unit to get 900 units. Now, we're going to take a look at target profit in terms of sales dollars. And we can use the equation method or the formula method. I like the formula method, as you can probably tell. And what we do if we walk through the equation here, here's the profit. We take the contribution margin ratio times the sales minus the fixed costs. So in this case, 40% times sales equals 100,000 plus 80,000. And finally, we break that down to the 100,000 target profit plus the 80,000 fixed cost divided by the contribution margin ratio. So again, we would have taken 80,000 divided by 40% to get to the break-even point in sales dollars. Now, if we want to have a target profit, we just add that target profit on top of our fixed cost and do the same thing, divide by 0.4 or 40%. So we need to make sales of $450,000 to achieve that $100,000 target profit. And here it is in the formula method. Target profit plus fixed expenses divided by the contribution margin ratio. Okay. Now, here they have an espresso stand, same information. Use the formula method to determine how many cups of coffee you would need to have to attain target profits of 202,500. So essentially what we're going to do, we're looking for how many cups, so we're looking for units. So we're going to take the $2,500 plus the $1,300 and divide it by the contribution margin per unit, which is $1.13. And that's exactly what you see they did here. And if I do that, it comes out 3,363 cups they'd have to sell to make an operating profit of $2,500 per month. Okay, this time we'll use the formula method, pretty much the same. And what we do here is we're going to, this time they want the sales dollars. So we do the same thing. We take our target profit plus our fixed expenses divided by the contribution margin ratio. And if I do that, I take the 3,800, that's the 2,500 plus this 1,300, and divided by the contribution margin ratio, which is the contribution margin per unit, or the contribution margin, divided by the net sales, or the selling price per unit. And that'll give you your 0.758. So that means we would need to sell $5,013 to hit that $2,500 target profit that we want. Okay, now we're going to take a look at showing the effects on the net operating income for changes in variable cost, fixed costs, selling price, and selling volume. So here we're going to change the fixed cost and the sales volume. What is the profit impact if RBC can increase unit sales from 500 to 540? But to do that, they need to increase their advertising budget by $10,000. Is that a good idea? Let's look. Here, we're going to do 80,000 plus the 10,000 additional fixed cost for advertising. That's 90,000, right? And so if we ripple this through 540 units times the $500 per unit selling price, that didn't change. Variable expenses didn't change, so contribution margin would be the 75 cents times the number of units, 540. But this time we're going to subtract out the 90,000. So we make 18,000, not 20,000. So sales did increase by $20,000, but the net operating income decreased by 2,000. So not such a good idea. Okay, so here, looking at this incremental analysis, here we can change the fixed cost and the selling volume. So if we got an additional 40 units from 500 to 540. So our increase in contribution margin, this is our contribution margin per unit, is $8,000. But we had an increase in advertising expenses of $10,000. So we had a decrease in net operating income of $2,000. Okay. Now, we can also change the variable cost and sales volume. What's the profit impact if RBC can use a higher quality raw materials? And that will increase the variable cost per unit by $10 to generate an increase in unit sales from 500 to 580 units. So is that a good idea? Well, let's take a look. Our selling price is going to be 580 units times 310. There's the increase in your variable cost per unit here, or 179,800, and that generates a contribution margin of 110,200. So that looks like a pretty good idea. I make $10,200 more for that sales increase of $40,000. Okay. Okay. That looks like a good place for us to stop this video. And when we return, we'll continue with some of these applications of CVP profits. Until that time, bye for now.